So welcome back. In the previous lesson, we have seen what is the face value of a share and what is the book value. And then we discussed as to why the face value remains the same year after year and how or why the book value changes. As the reserves and surplus keep on increasing from year to year, the book value keeps on increasing. We have seen why that happens. And then we left it with the question as to why the market price is not close to the book value of the share. So now before we come back to the basic two questions as to why the shares are continuously traded and why should the market price of the shares fluctuate so much, we will find a logical answer to the market price of the share. Alright? Now consider this. When you go to the market and you buy fruits and vegetables, or maybe a washing machine or a dishwasher, or maybe a car for your personal use, or maybe clothing, when you buy these things, you buy these things for your consumption or for your usage. You want to use or consume these things. So what happens is that you will look at their value or their worth, what it is today. You don't want to see how much they will be worth tomorrow, but how much is their value today. That is what you are interested in looking at. Because over a period of time, these things will get consumed and lose their value. They will eventually become zero. Once you eat the fruits and vegetables, their value is zero. You buy a dishwasher, a washing machine, a car, you use it for a couple of years, maybe 5 years, 10 years, 15 years, then their value becomes zero. Similar is the case with the clothing. You use the clothes for a year, 2 years, 3 years maybe, then their value is zero, isn't it? But when you invest your money in a company or you buy a business or buy a share in a business, then you are actually not buying it for the purpose of consumption. You are buying the shares or that business to generate more money. Got the point? Here you are not buying them to generate more money. Here you are buying them to use or consume them. But you don't consume the factory. You don't consume your shares. You are putting your money in the shares or a business for that money to grow and multiply. How much your shares can generate more money for you. So rather than looking at what its value is today in the books of accounts, you want to see how much more money it can generate and how fast it can generate. Isn't it? Say for example, if the book value of the share is only 50 rupees today, but you will have a look at it as to how much can it generate in future. Can it become 100? Can it become 200? Can it become 500? So if it can grow and grow fast, then you are willing to pay more than 50, more than its book value. You may pay 70, 80, 90, 100, maybe more than 100, maybe more than 150, depending upon how fast and how much money it can generate. But if it cannot generate money, the faster it can generate money, the more you are willing to pay for it. But if it is not likely to generate money, if its book value today is say $50, but you know that this particular share or this particular company cannot generate more money for me or cannot generate money fast enough, then you will not be willing to pay even $50 for it, not even what it is worth in the books today. You may be able to pay only maybe $30, maybe $20, not even what it is worth in the book today. So got the point? Now the thing is that the market price of the share depends on your perception and your analysis as to how much money the company can generate in future and how fast it can generate that money. We have seen that in the previous slide. It depends on your perception and your analysis. If your perception and analysis tells you that this particular company can make lots of money and make it very fast, then you will be willing to pay much more than its book value. But if your perception and your analysis tells you that this company is no good, it is not likely to make good money or not likely to make money fast enough, then you will not be willing to pay even what its worth is in the books today. Got the point? And since the perception and the analysis change from moment to moment and day to day, the market price of the share will keep changing from moment to moment and day to day. So now you know why the market price changes. The market price changes not because of the face value, not because of the book value, but because of the change in your perception, the change in your analysis. And then the question remains as to why the perception and analysis must change from time to time or moment to moment. Or who does the analysis and who changes the perception? Why does the perception and analysis change? Now, you see, if you are an investor in the business, if you have invested your money in a business or a share and you want that money to grow, then you will not frequently buy and sell those shares. You will invest your money, buy the shares, and patiently wait for years for that money to grow if you are confident about that business and if you are an investor. But the problem is that in the stock market does not have only investors. There are many players in the stock market, and each one is having a different interest, a different purpose, and a different agenda. Every player in the market has got a different interest, a different purpose, and a different agenda. And therefore, their analysis and their perception keeps on differing. As the analysis and perception keeps on differing, the market price will keep changing. Somebody is wanting to pull the price up, somebody else is wanting to pull the price down, somebody wants something, somebody wants a different thing. So that is why the price will keep changing. Alright? And who are these players? Who are these players in the stock market? One is the investor. The investor puts its money and then he waits for that money to grow for a few years. But we are not talking only of the investors. Who are the other players in the market? What are their interests? What is their purpose? What is their agenda? Once we get answers to these questions as to who are the players, what is their purpose, what is their agenda, then these two questions of ours will be automatically answered. Alright? Once we know who these players are and what is the purpose or the agenda or the interest of these players, then we will get answers to these questions. You got my point? So we will meet these players or we will see who these players in the market are in our next lesson. Alright?